All right, welcome back to The Explainer. So, if you've been anywhere near the financial markets lately, you've definitely seen the headlines. Shopify is absolutely on fire. Today, we're decoding exactly what is happening behind the scenes of their Q2 2026 earnings report. We're going to look at the raw numbers, unpack Wall Street's aggressive reaction, and figure out what all of this actually means for the rest of 2026. So get ready, because we're breaking down the reality behind one of the most explosive quarters we've seen all year.
25%. Just let that sink in for a second. The stock shot up over 25% in pre-market trading immediately following the earnings release. In the world of mega-cap tech and e-commerce, a move like that is just staggering. You have to ask, did they just beat expectations, or is there something much, much bigger happening under the hood here? Well, the short answer is absolutely yes to both. This wasn't your routine everyday earnings beat. This was a major, undeniable statement to the market.
And Shopify's president, Harley Finkelstein, definitely did not mince words. He bluntly stated, this was a monster quarter. More than 30% growth in GMV and revenue and gross profit and free cash flow. No one else comes close. You can literally feel the high energy and just the sheer scale of the financial victories the company secured this quarter. I mean, when leadership comes out swinging with a statement like that, you know we need to look closely at the data backing it up.
Okay, let's dive into this. Section 1. Unpacking the core numbers.
Let's start with the absolute core metrics for the second quarter ended June 30th, 2026. Wall Street was expecting a solid quarter, sure, but Shopify just over-delivered across the board. Raw revenue came in at a massive $3.58 billion. That is a 34% increase year over year, which handily beats the analyst consensus of $3.45 billion. And looking at the bottom line, adjusted earnings per share hit 42 cents, smoothly beating the 40-cent estimate. They didn't just edge past the goalpost here, they practically sprinted past it.
And there's a really stark contrast between expectation and reality here. See, Wall Street was actively bracing for a slowdown in gross merchandise value. They expected growth to cool off into the 27% range. But instead, Shopify accelerated. They delivered 32% GMV growth, hitting a staggering $115.6 billion. And keep in mind, this acceleration is stacked on top of an already incredibly strong second quarter from the previous year.
Which brings us to the cash. $654 million. That is Shopify's free cash flow for the quarter. To put that figure into perspective, it represents a dramatic 55% surge compared to the exact same period last year. It's one thing to grow your revenue, right? But to grow your actual free cash flow by 55% at this kind of massive scale, that proves the fundamental economics of the business are just operating at peak efficiency.
And when we translate that raw dollar amount into a margin, we get an 18% free cash flow margin. That's up from 16% last year. Now, this isn't just some boring accounting footnote. This is a clear-cut story of strong financial discipline. They're showing everyone that they can aggressively grow their top line while actually expanding their profitability metrics. And honestly, that is exactly how a company consistently rewards its shareholders.
Now, a quick heads up on understanding the nuance behind the earnings per share numbers you might see flashing on financial news tickers. You might actually see a massive GAAP EPS of 116 reported. However, that specific figure was largely driven by capital investments and various one-time factors. That is exactly why analysts strip out all that noise and focus on the adjusted EPS of 42 cents. It just gives us a much cleaner, far more accurate gauge of the core recurring health of the underlying business.
Moving right along, Section 2, Growth Engines and AI. So when you break down exactly where Shopify's money is actually coming from, the primary merchant solutions arm, which by the way is heavily driven by their payment processing fees, absolutely dwarfs subscription revenue. We're talking $2.78 billion from merchant solutions, while subscriptions brought in $802 million. At its core, Shopify is fundamentally a platform that succeeds when its merchants succeed and process more payments.
And the crazy thing is, both of these primary revenue engines are just firing on all cylinders right now. That $2.78 billion in merchant solutions, that represents a massive 37% jump year over year. Meanwhile, the subscription revenue rose by a very healthy 22%. But there is a surprise third factor at play here that the company is heavily emphasizing right now.
That third engine is artificial intelligence. Now, there have definitely been some concerns in the broader market recently that the high costs associated with AI are pressuring gross margins. And it's true, we did actually see gross margins in this subscription segment dip slightly to 79.7%. However, Shopify is proving that this investment is fundamentally paying off.
They're successfully utilizing AI to attract new merchants, drive consumer demand, and ultimately expand what's possible for businesses of all sizes on their platform. So AI is acting as a true growth lever here, not just some expensive sunk cost.
All right, let's talk about the market reaction. Section 3, the relief rally.
To really understand that 25% pop, we have to look at the context of the stock's tough slump earlier in the year. From January to July of 2026, Shopify shares had pulled back significantly. They dropped 27%. A lot of this was driven by pervasive market fears about competition from pure-play AI companies like OpenAI. Basically, the market was anxious, assuming the absolute worst. But by completely disproving that expected growth slowdown on earnings day, Shopify forced Wall Street into a textbook relief rally, perfectly mixed with a legitimate fundamental beat.
Now, the market is always looking ahead, right? And for a high-growth stock, forward guidance is everything. While Shopify delivered a highly positive outlook for the third quarter of 2026, they're projecting revenue to keep growing in the low 30s% range. This is huge, mainly because it easily beats the 24 to 26% growth that the market had originally priced in before the call. Furthermore, they project a free cash flow margin in the high teens to low 20s, which strongly suggests their margins could actually continue to expand, even as they actively invest heavily in future growth.
So, pulling this all together, here is your core takeaway. Shopify has successfully reached a true inflection point. With revenue up 34%, GMV up 32%, and free cash flow surging 55%, they are completely defying the narrative of an e-commerce slowdown. They've successfully monetized their platform through robust payment solutions, and they've found the perfect blend of high growth and strict financial discipline.
Which leaves us with the ultimate question for you. Seeing how Shopify has leveraged AI and payment processing to orchestrate this massive quarter, are you buying the rally or are you waiting for a dip? Let me know your thoughts in the comments. And hey, if you want to dig into the raw data yourself, I highly recommend checking out their full 10Q filing on the SEC's EDGAR system or their investor relations site. Thanks so much for joining me for this explainer, and keep learning.